Hi, everybody, and welcome to our class. Today, we're going to talk about bear put spreads in the ratio of 1/1 and 1/2. We're going to talk about this kind of spreads, how they work, how they can be beneficial, and what are the things that we should keep in mind and be aware of. All right. So first of all, what is a bear spread? 1/1. Well, that's a regular bear put spread is a type of option strategy where an investor expects a moderate to large decline in the price of a security or an asset and wants to reduce the cost of holding the option trade. A bear put spread is achieved by purchasing put options while also selling the same number of puts on the same asset with the same expiration date at a lower strike price. The maximum profit using this strategy is equal to the difference between the two strike prices minus the net cost of options. All right, so as you can see here, I put a nice example. We can see here that we're assuming that the strike price is at 100, and what the strategy, we're doing it by 1/1, we're buying a put option, which can be in the money or at the money, doesn't have to be deep in the money. And so we're assuming that the cost will be $10 and we're selling one put option, which is going to be put 90, and we're going to generate $5 from the selling of this put. So all in all, in total, the graph is going to look like that. The black line is the naked buying put. And as you can see, if we're just buying a naked put and paying $10 for it, then our break even is going to be at 90. And from the 90 point and downwards, we're going to start making money, generating profit. Thing is, we're already spending $10. That means that if the market's going to go up, we're going to lose $10. And if it doesn't reach, even if it goes down and it doesn't reach 90 strike, then at any point between 90 to 100, we're still going to lose money. And this is why this strategy is all about and why it could be beneficial and is a better strategy. If you're not too fancy about diving the market down and you're thinking it might go down a little bit, I don't know how much, but I'm not also too greedy about earning a lot of money and burning the entire market, then you can just sell out of the money put and reducing your costs. So then you can see that we're paying 10, but we're getting $5 back. And that basically means that, if the market's going to reach only 90, that means that it fell 10%, which is significantly pretty high. You can see that we're at the 90 point, and this kind of strategy, we're still going to make a $5 revenue. And we're going to get a break even at 95 and not at 90. Well, that means that, furthermore, it means that our entire risk has been reduced to just $5. And that's the maximum loss we're going to suffer, only $5 instead of $10. And that's quite a difference. Now, thing is, if it's gonna go down extremely further, then we're still gonna generate only $5. And on the other hand, the maximum loss can be just $5, and that's it. So, this is kind of circumstances and things that you can keep in mind when you're trying to go buy a put option. But you don't have to get the entire exposure to the option price. Then you can reduce it by selling one. It doesn't going to cost you any margin requests. And, if you're being realistic, not all the times markets fell and crashed pretty hard. And if they're going down by a few percentage, then this kind of strategy can be a very good one for you. Okay, so that was the 1/1. Now let's see what it means, bear put spread 1/2. Now, in this example, it's going to be the same example, but this time we're going to sell two put 90 options, which are going to generate us $10 revenue from selling those. And we're still buying the $10 100 put. So that means all in all, basically we're buying this 100 put with no money. That means that the sell of the two put options gave us exactly the amount of the cost that of the buying of the one put around the money. So that means that all in all, we haven't spent any money, right? So we bought it for 10 and we got 10. So we're in zero. So as you can see on the graph, that means that if at expiration date, the market will remain at 100 or strike or expire at 100, then we're not going to lose nothing because both of these options expired worthless and we didn't lose anything. So that's not bad. And if it goes up to 110 or 120 or even as high as you want to go, you're still not going to lose nothing. So that's that bad. What? Okay, so the pros for this kind of strategy is that, of course, you're getting a reduced cost of put buying or even more than the cost. And so, yeah, you can get even more than the cost if, let's say, you could have sold it even, let's say it has been traded at 6, then you would have generated a $2 profit any point above 100. So this might be also beneficial if it goes up. Okay. And second thing, when you're selling too, you can get a greater break-even point. That means that in this example, when we're selling two put options, we're going to get a break-even point at 80. Okay, so that means that we're getting here a spread which is vertically 20% from our current strike price. And, you know, if you don't believe that the market is going to fall all the way to 80, then you can generate a good profit from going downwards. And in total, keep in mind that we're buying one put and we're selling two puts. So all in all, together, we're just one short put in total. So that means that if we're going to buy one more put, then we're going to reduce entirely our entire risks. Okay. The cons of it, and this is the most important thing, endless profit loss. Even though the market goes up, you won't lose any money. If the market crashes, and sometimes it does crash, then you're gonna lose a lot of money, and potentially it's almost an endless loss. And you need margin requirements in this kind of strategy because you're selling basically one naked put with no protection, with no hedging. So if you're being realistic, sometimes the market does not crash. And you can, you know, it's only depends on your risk management. If you believe and you're taking your chances, then that's a good strategy, not spending. Important thing, try to find a good skew spread between the two options. Buy a put with a lower IV and sell higher IV. You know, as they always tell you, good businessman buys at low price and sells at high price. This goes the same in options. And you have to try to find a good skew spread. When I'm talking about skew spread here, you can see here on AMC, as you know, recently this stock has skyrocketed and had a really high implied volatility because of all those movements that she had. And you can see here the skew of its put option series for our example. And you can see today the AMC has been traded around 45, 42, 50, something in this region. And you can see the implied volatility of the put options is around a little bit more than 160%. But you can see that the implied volatility rises as we go down with the strike price. And you can see that the implied volatility on put options out of the money is greater. So you can see that we're talking about here near strike price of 35. It rises to 170, and at 30, it goes well above 170%. So that means that those put options out of the money or deep out of the money are more expensive because they have a greater implied volatility. On the other hand, if you're going to buy put options deep in the money, then you're going to buy them at lower implied volatility, as you can see here. And that means that they are less expensive. So buy cheap here or here and sell here, more expensive. This is how you do business. Now, another tip, very important, after some time, if all goes well and the other one doesn't fall too much and days go by, then what happens usually with options that the deeper the out of the money options, they tend to lose value first. That means that, as time passes, these out of the money options really far from the money, they tend to lose their value faster than those ones who are closer to the strike price. So my advice to you is really go and buy at least one of those sold put options back, and this will now guarantee no break-even point and potential losses on the downside. Okay, so let's go now into some examples. And I want to talk about today the AMC, as we spoke about her. So here we're going to see that the option today, the stock has been traded today around 40 something dollars. And we're looking at this series for 1 month from now, 31 days to expiry. And this is, of course, the call side, and this is the put side. And today we're going to talk and look on this side. And we're looking at put, and we're thinking that AMC is going to go well below 42. And so we're buying a put option. But to-dum, you're not the only one who's thinking that AMC is going to sink. And as you can see, the implied volatility here is around 164%. And if we're going to try to buy this put 42, we're going to need to spend at least $850 for buying 100 put options. So let's see. If we're going to put it on a graph, then you can see here our risk profile. And that means that we have 31 days till expiry. That's the blue. Well, now we're going to look at the light blue line. You can see that if we're buying put 42 for $8.50, then we're going to need AMC to fall all the way down to 33.5 so that we can just break even. Otherwise, if it doesn't move the entire month, then we're gonna lose maximum of $850. And if it's gonna expire somewhere between 42 and 33.5, then we're gonna lose less. Okay, so when we're considering a spread strategy, so then we're gonna probably need to sell one out of the money put option. And as I look here, I can see that I spent $8.50. So I want to sell one put. So I'm looking now, let's say we just sold the put 36 and we got for that just $5.20. Okay, so let's see how it's going to look. Our risk profile is going to look like. So we're sold here, put 36, and now our graph is going to look like that. Minimum loss is going to be now just $330. That's the difference between those two options. We bought for $850 and we sold for $520. So that all in all reduces our risk to $330 maximum loss. Okay, but on the other hand, if the stock collapses all the way down, then we're still going to generate around $270. This strategy does not take any margin, doesn't need any margin request, as you can see here, and our theta effect is kind of negative, much better than the previous theta that we have. If we just have bought the solely just bought the put option, then we have at this point negative theta of minus 13. So if we're going to sell this put 36 for $520, then we'll automatically reduce our theta effect. We can see it's now just went down almost to $1.50. Now, so we got this kind of strategy, and as we said, we can also sell another one, and then we're gonna have this kind of strategy. Now we bought one, you can see here, and we sold two put options at 36, which generated us $10.40. And that means that we have now even a total net cash balance of almost $200. That means that if the stock will rise, still we're going to generate profit of $200. And if it goes on and on, goes upwards, still we're going to generate this $200. On the other hand, we're getting a break-even point, which is going to be exactly at here, 28. From 42, 43 to 28. And that's a big spread. I mean, the stock needs to go down almost 30% just to meet this break-even point here. Okay, so if you believe and you think that AMC will not drop all the way down to below 28 in 31 days from now, then you're going to generate profit for real, for real. That means it's kind of a big spread. And as you can see, because we generated more income and from this strategy, we got even a net cash balance of $200. And that means that we're widely open all the way up. So we don't have a break even on the right side, on the upside. And on the other hand, we're still having a quite big spread till our break-even point. And even though afterwards, I mean, if it's gonna fall to 27, then still we're gonna lose just $100, which is not so bad. Furthermore, our maximum profit is gonna be right here at 36. If the expiry in 31 days from now are gonna be at 36, then we will make $753, which is a great investment, because we only had here initially $800 margin request. So we put aside $800 margin request, and we've made more than $750. So it almost goes by the ratio of 1:1 for the margin request, which is also something that could be very, very interesting. Keep in mind that your margin request will rise as the stock will go as far as 36, then your margin request will rise to $1,400 almost. You can play with it. I mean, you don't have to sell exactly the 36, but you can also sell, let's say, 32. Let's say we just sold one. Okay, and let's say we just sold one, put 36, and if we're gonna look now, I can see that put 32 has an implied volatility of almost 171%. And it also gives me not bad money. Let's say we're gonna get $3.50 instead of selling those both on 36. Now let's see. As you can see, we got here something that looks like a strangle, but since we've sold a further deeper in the money put option, now we got to break even at 25. If you remember, we had a somewhere here. Previously, we had a break even at 28. Now we're gonna have a break even at 25. Well, 26, 25.8. So we got $2 more and a wider spread for this strategy. Although keep in mind that now we almost generated the same amount of money that we spent on buying this 42 put option. So then that means that if the stock will rise up, then we're only going to get the small difference between those buying and selling, and that's going to generate us only 20 something dollars, or $20 exactly at the expiry date. And also our maximum profit won't be 750, it's going to be a little bit more than 600, but still we got a wider and greater break-even point. So now stock needs to move even more than 40%. So we're gonna start losing money. So you can see that we can do these kind of spread options 1 by 2, and not necessarily just by the same strike, but you can sell one strike deeper in the money. Now, let's say you're scared, and I can understand, and you're not too sure that 25 is going to be enough here for this break-even point. So what you can do it all over again. And now, let's say you want to widen it even more. So I'm suggesting buying the put 30. It's going to cost us $3. Okay, and we bought just one, but we bought a dip out of the money put option 30, which is very far from the strike price, and it's cost us $300. And now our maximum revenue is going to be just a little bit more than $300, and we're getting a break-even point now, and we're going to suffer a maximum loss of $280, almost $300 loss. But as you remember, we're talking about spreads, and so now you can go and buy, as we bought the put 30, and sell a further one. Now I'm looking here, and I see that these 22, which are the last ones, you see, called put 22, is the last one in this option chain right now, and it has an implied volatility of over 188%, and I can get more than $1 from selling those. So what I can do is I can sell 22 puts, so that they will, for exactly $1, and now they're gonna give me exactly back the whole money that I spent on buying this one long 30 put. And look, keep in mind that I've sold now deep in out of the money put options. What's gonna look like now? It's going to look like this. We're going to have a break-even point now at 20.6. Remember that the stock is currently traded at around $42, $45 in the last week, and we're going to give this stock 30 days not to go down further than 50%. So as long as AMC, we're going to be here between 20 and 20.6, doesn't fall below it, we're going to generate money. And that means that if it goes up, we're not going to lose, or even we're going to have a small profit. Let's say we're not going to have any profit, we're not going to lose anything. And our initial thinking was that we're going to go short AMC for the upcoming month, but we don't want to spend too much money, and we want to have a great spread all the way, almost 50%. Now, you can say, and I agree, it's gonna, if it falls, it can fall even below 20, and then now you're already sold 2 put options, and you're gonna suffer harder and greater losses even if it goes below 20. So I'm saying what you should do, if you don't want to lose and avoid losing money, try to wait a little bit and try to buy, first of all, those put 22 options as soon as they fall below $1. And then for sure, you're going to have you're going to improve your delta and your losses and your loss potential. So let's have a demo. Let's say after, I don't know, a week or 2, and we were able to buy those 3 back, and let's say they fell all the way to 0.2. Okay, so we're gonna spend a total of $60. And now look what happened. Nothing. There is no break-even points anymore. You see, if we're gonna go down all the way, nothing's gonna happen. We're still gonna generate $360 and our margin request fell to 0. Okay, so this strategy is good because we're selling far, far away from the money put options. And sometimes you can take your chances and make some good money. But remember, keep in mind that those very far out of the money put options, they tend to burn out first, even though they have a very high implied volatility. As time passes by, they are the first one, they're going to lose their value through time decay. And of course, investors will also drop them off. And it starts with those who are the forest, and then it goes closer and closer to a strike price. And this is how the theta will affect them. And you need to be calm and close it as soon as you're willing to close it. Okay, so that was our example for bear spreads 1 by 1 and 1 by 2. I strongly advise you always to close your strategies. Try to build them as wider as you can, but on the first opportunity that you have, just buy at least one of those 2 sold put options so you won't put yourself on a risk. Always be smart, be careful, and I'm wishing you all the best luck, and hope to see you in our next lesson. Goodbye, everybody.